Hello everyone, and welcome to Virginia International University's MBA 603 Contemporary Issues in Accounting subject. Today we're going to be talking about an introduction to accounting for state and local governmental units. Up to this point through the semester, we've generally focused on commercial entities and generally accepted accounting principles as they apply to those entities. And that's whether it's respect to consolidation or with respect to merger and acquisition activities. We talked through numerous very complex contemporary issues this semester. And so we're going to switch focus a little for the rest of the semester and deal with this state and local governmental units, as well as some of the other chapters that cover estates and trust and tax issues. And so our goals for this session are to learn about the historical development of accounting principles for state and local governments, to understand the need for fund accounting and its basic premises, and to perform some transactional analysis using proprietary and governmental accounting models. We'll also discuss and recognize various fund categories as well as their measurement focus and basis of accounting. We'll review some of the basic governmental accounting principles, and finally we'll learn about the contents of a government entity's comprehensive annual financial report. And this is growing in importance, this comprehensive annual financial report, simply because regulations mandate that government agencies now be able to issue financial reports and essentially have the same level of accountability as commercial organizations, in as much as they are spending taxpayers' dollars. And they are having a very difficult time doing this. They're being audited by the auditing firms and having a very difficult time getting through some of the audits because of the complexity and the nature of their transactions and just the sheer size of some of the agencies. So let's talk a little bit about the history or the historical perspective. According to the U.S. Census Bureau's 2012 Census of Governments, there are more than 91,000 general and special purpose governmental entities in the United States. A governmental entity is generally created for the administration of public affairs and has one or more of the following characteristics. It's popular election of officers or appointment of a controlling majority of the members of the organization's governing body by officials of one or more state or local governments. The potential for unilateral dissolution by a government with the net position reverting to the government, and the power to enact and enforce a tax levy. And so again, these are the characteristics of a governmental entity. And like we said, that there, at least as of the 2012 census, there were more than 91,000 of these general and special purpose governmental entities. So with anything that large, obviously, you can appreciate the importance of getting measurements, reliable measurements, on the activities of those entities. And so these governmental units, not-for-profit organizations, colleges and universities, and some healthcare entities are deemed different enough to warrant the establishment of accounting standards for their specific use. In fact, generally accepted accounting principles, or GAAP, of state and local governments are established by the Governmental Accounting Standards Board under the auspices of the Financial Accounting Foundation. As you'll recall, GAAP for businesses and other non-governmental, that would be essentially private, not-for-profit organizations, are established by the GASB sister organization, the Financial Accounting Standards Board. So, there are just these two separate boards that develop these guidelines and requirements, one being the Governmental Accounting Standards Board and the other being the Financial Accounting Standards Board. And so similar to for-profit organizations, there's a hierarchy of how generally accepted accounting principles are to be interpreted and applied. In March of 2009, GASB issued Statement Number 55, the hierarchy of generally accepted accounting principles for state and local governments. And then in December of 2010, the GASB issued Statement Number 62, the codification of accounting and financial reporting guidance contained in pre-November 1989 FASB and AICPA announcements. The GASB largely kept the hierarchy that had been in place for 20 years, but incorporated that guidance formally in the GASB authoritative literature rather than the auditing and FASB literature where it had resided. GAAP guidelines for state and local governments include the following, and these are listed in descending order of authority. So GASB statements and interpretations, they're semi-annually incorporated into the codification of government accounting and financial reporting standards. The GASB technical bulletins. This category also includes AICPA industry audit and accounting guidelines and statements of position if specifically made applicable to state and local governments by the AICPA and cleared by the GASB. The consensus positions of GASB, Emerging Issues Task Force, and AICPA practice bulletins if specifically made available to state and local governments by the AICPA and cleared by the GASB. And then finally, interpretation guidelines published by the GASB staff and industry practices that are widely recognized and prevalent in state and local governments. If none of these provide adequate guidance, governmental entities should consider other accounting literature, including GASB concept statements, Standards of the International Public Sector Accounting Standards Board, FASB standards not made applicable to governments by a GASB standard in textbooks. So when addressing an accounting issue, government financial statement preparers should first look to GASB statements and interpretations, followed by the technical bulletins, and so on. And so now let's turn our attention to this idea of fund accounting and talk about it a little. So governmental accounting and financial reporting differ from corporate accounting and financial reporting. The primary reason for the differences are that governments lack a profit motive and must focus on demonstrating accountability to the public and governmental authorities. Governments focus their continuing ability to provide and fund goods and services rather than on measures of income. Since GASB Statement 34 was issued in 1999, state and local governments must utilize two bases of accounting and two measurement focuses. And so, state and local governmental units engage in both business-type activities and general governmental activities. Business-type activities provide services to users for fees that are intended to recover all or at least the primary portion of the cost of providing the services. And these include activities to provide services to entities outside the government, such as water and sewer services, electrical services, golf courses, transit systems. And then others provide services to departments or agencies within the government, such as central motor pool, self-insurance activities, and central printing and data processing services. And then there are central governmental activities, and they provide goods and services to citizens without regard to their ability to pay. The level of goods and services provided is mandated by the citizens through their elected officials or is deemed or determined by persuasion from a higher level in government. So generally, governmental activities such as police and fire protection, road maintenance, are usually financed by taxes or intergovernmental grants and subsidies, and there may be no relationship to the people receiving the services and those paying for them. Because general governmental activities and business-type activities constitute two different models of financing and providing services, governments are said to have a dual nature. Furthermore, the existence of restrictions on most governmental resources is the primary reason for fund accounting, which is a major feature of governmental accounting that helps governments demonstrate compliance with resource restrictions. And so fund accounting supports the practice of restricting financial resource usage to specific purposes as a means of controlling governmental operations, and it also accommodates the different accounting bases that general governmental activities and business activities are business type activities used for resource allocation. It is a system that requires multiple accounting entities called funds for a single government. Governments use an individual fund to account for a certain business type activity or a certain subset of general governmental financial resources that are set aside for a certain purpose or purposes. So the GASB defines a fund as a fiscal and accounting entity with a self-balancing set of accounts recording cash and other financial resources together with all related liabilities and residual equities or balances and changes therein which are segregated for the purpose of carrying on specific activities or obtaining certain objectives in accordance with special regulations, restrictions, or limitations. And so we note that because a fund is an accounting entity, each fund has its own accounting equation, its own journals, ledgers, and other accounting records needed to account for the effects of external transactions or inter-fund activities on the net position or activities accounted for in the fund, and its own financial statements that report on behalf of the fund itself. Business type activities are accounted for in a category of funds called proprietary funds. General governmental activities are accounted for in governmental funds. And so we have this third category of funds, which is the fiduciary or trust and agency funds. Most transactions or inter-fund activity within funds in this category are accounted for like proprietary funds. Hence, learning how to account for proprietary funds enables us to account for most fiduciary funds as well. So the most effective way to understand the nature and working of funds is to understand the basic accounting model or accounting equation. Proprietary funds are explained first because accounting for a proprietary fund is very similar to accounting for a commercial business. A simplified accounting equation for a proprietary fund is current assets plus non-current assets minus current liabilities minus non-current liabilities equal the net position. Accounting for general governmental activities differs from the accounting for business type activities. Governmental funds in their purest and simplest forms are essentially working capital entities. The simplified accounting equation for a governmental fund is current assets minus current liabilities equal fund balance. The measurement focus of governmental funds is current financial resources. Although this equation becomes complicated by practical considerations, it's important to continue to think of governmental funds as working capital entities which focus on current assets and current liabilities even as you address more advanced issues. In fact, governmental funds generally record expenditures to reflect the use of governmental fund working capital instead of traditional expenses. And so, when comparing the proprietary and governmental fund models, note that non-current assets, that's fixed assets, and long-term liabilities are excluded from the governmental fund equation. General governmental activities, however, require significant investments in fixed assets, and governments commonly incur large debt obligations associated with investments in fixed assets. General governmental fixed assets, that is, all fixed assets except those of specific proprietary or similar fiduciary funds, are referred to as general fixed assets. Although governments do not account for and record these fixed assets and their depreciation within the governmental funds or governmental fund statements, they do maintain fixed asset records. The general fixed assets and related depreciation are reflected in government-wide financial statements, which are discussed later. And so now let's talk some about transaction analysis. So let's consider the example where we borrowed $15,000 by issuing a 3-year note. We purchased equipment costing $2,800 for cash. We sold a fully depreciated truck costing $18,000 with a net book value of $1,200 for $1,000 worth of cash, and we computed current depreciation as $875. So let's look at how we record these transactions under the proprietary and governmental fund models. And so as we can see, using the proprietary fund model, and let's remember our model, which says current assets plus non-current assets minus current liabilities minus non-current liabilities equal net assets. So if we look at our first example, we borrowed $15,000 by issuing a 3-year note. So we increased our cash, right, current asset by $15,000, and we increased our non-current liabilities by $15,000. We bought equipment of we purchased equipment costing $2,800 for cash. So we reduced our current liabilities and increased our non-current assets by 2.8. We sold a truck for $1,000 cash with a net book value of $1,200. So we increased our cash by $1,000, and we decreased our non-current assets, which would be our fixed assets, that for the net book value of the truck of $1,200. And then we computed depreciation of $875, which again decreased our non-current assets through depreciation, accumulated depreciation, and we decreased our net assets by that same amount. And so here, using the proprietary fund model, you can see that the entries that we would make as a result of these transactions. And so now let's look at the governmental fund model, where we know the model is current assets minus current liabilities equal to fund value, or fund balance. So we know, again, we borrowed $15,000 with a notes payable, and so that increased the current assets and increased their fund balance. We bought a truck for $2,800, or purchased equipment for $2,800, which decreased their cash, and we sold a truck for $1,000, which increased our cash or our current assets. And so we again see the transactions here as impacts with respect to working capital, and so we're missing the sides of the transactions that don't have to do with current assets and current liabilities, because those sides don't impact the working capital aspect of the governmental fund model. And so by issuing a 3-year note, well, that's not a current liability, that's a long-term liability. So we simply note that, but we don't record it to the governmental fund model. So we sold a fully depreciated truck costing $18,000 with a net book value. That transaction doesn't really have anything to do with current assets or current liabilities. It's simply a fixed assets being a non-current asset. But we did receive $1,000 for it, and so we increased our current assets by that $1,000. And the same is true where we bought equipment. We bought equipment and spent $2,800, and even though we got an asset, the other side to that entry is in non-current assets. So for governmental fund model purposes, we ignore that side of the entry. And so you can see it's a big difference between the two, the recording and the treatment of the two, between the two models. And so now let's talk about fund categories or fund types. And so 5 types of governmental funds are used to account for general governmental activities. Each is a working capital entity that accounts for only a portion of the general governmental working capital. The difference between these funds, then, is the purpose or purposes for which the working capital accounted for in each of them may or must be used. So we talk about special revenue funds. They account for general governmental financial resources restricted for specific purpose. Permanent funds report resources whose use is permanently restricted. but whose earnings are expendable for the benefit of the government or its citizens. A capital projects fund accounts for resources to be used to construct or acquire a major general governmental fixed asset and the related current liabilities. A debt service fund accounts for resources to be used to pay principal, interest, and related charges on general long-term debt. And finally, the general fund accounts for working capital available for general use. A government has only one general fund, but it may have any number of other fund types. Recall that each of these governmental funds has the same accounting equation that was discussed and illustrated earlier for generic governmental fund. The only added complexity is we must understand which governmental fund is effective in order to account for general governmental activities properly. So governments account for their business type activities in one of two types of proprietary funds, either enterprise funds or internal service funds. The primary distinction between the two types of proprietary funds is that governmental units use inter-service funds to account for activities operated and financed on a business-type basis that provide goods or services either solely or almost solely to internal customers, that is, other departments or agencies of the government. Governments use enterprise funds to account for business-type activities that serve primarily outside customers, typically the public. Enterprise fund activities often provide services to internal customers as well, but those customers are not the predominant customers. And then finally, we have these fiduciary fund types. And you'll note that all fiduciary funds contain resources held for the benefit of parties other than the government itself. And so, pension trust funds account for governmental pension plans if the government acts as a trustee. Investment trust funds account for the external portion of investment pools reported by the sponsoring government. And private purpose trust funds report all other trust arrangements whose resources provide benefits to parties outside the government. These funds use the basic proprietary model of current assets plus non-current assets minus current liabilities minus non-current liabilities equal their net position. And then there's this fourth agency fund, and these are essentially receive, hold, remit, or bill, collect, hold, and remit accountability devices, which account for resources a government is holding as an agent on behalf of parties outside the government. For example, an agency fund may be used to record payroll taxes withheld and remitted to a higher government. And the accounting equation for the agency fund is assets equal liabilities. So no revenues, expenditure, expenses, or transfers are reported in an agency fund. And so here we're just talking about some typical transactions that a government would execute. So one, we issue general obligation funds, par value of $3,000 at 101 or a premium to finance construction of a government office building. This is often done to finance the building schools. The second transaction transferred the premium on the bonds to the fund used to account for payment of principal and interest on the bonds. The third, incurred and paid building construction costs of $125. Fourth one would be levied and collected sales tax restricted to use for economic development of $60. Fifth is we paid general governmental employee salaries of $450 and accrued an additional $50. And then finally, six, we borrowed $7,500 on a 6-month note to finance general operating costs of the government. So let's look at how these transactions would be recorded. And so if we go down item by item, we see that for the specific funds, for the first item would be a capital projects fund. So we issued the general obligation bonds, par value of $3 at 101, so we issued another premium and received $3,030, and that increased our current assets and increased our fund balance. The second one, we transferred the premium on bonds to the fund used to account for payment of principal and interest on the bonds. So we simply transferred the $30 of premium to a different fund, and so we reduced the current asset portion. And I won't go through each of these, but I think you can see that as you go down each transaction in this particular model, how that transaction is reflected transaction item by transaction item in the model and across either current assets or current liabilities. And so key aspects of the proprietary fund and governmental fund models are the basis of accounting and measurement focus used for each. Consistent with having fundamentally different accounting equations and models, government and proprietary funds use different bases of accounting in measuring financial position and operating results. The GASB specifies when the accrual and modified accrual basis of accounting are to be used. In essence, the accrual basis refers to recognition of revenues and expenses as in a business accounting. It follows the economic resources measurement focus, whereby all economic resources, whether current or non-current, are reported. The modified accrual basis refers to recognition of revenue when resources become available to meet current obligations and recognition of expenditures when incurred. The modified accrual basis of accounting is consistent with a flow of current financial resources measurement focus, whereby funds report on current resources and current obligations. And so now we'll talk about some governmental accounting principles. So government revenue sources are varied and include taxes, grant receipts, collection of user fees, and fines. Revenue recognition within governmental entities is determined by the nature of the underlying transaction. GASB Statement number 33, Accounting and Financial Reporting for Non-Exchange Transactions, characterizes revenue transactions as either exchange and exchange-like transactions or non-exchange-like transactions. Exchange-like or exchange transactions are those in which each party receives and gives up essentially equal values. Non-exchange transactions are those in which a government gives or receives value without directly receiving or giving equal value in exchange. Many of the transactions in governmental funds are non-exchange in nature because general governmental activities often address the needs of the public and are funded by taxpayers who generally do not receive benefits in direct relation to their tax payments. And so, in general, a transaction should be substantially complete prior to revenue recognition. However, the modified accrual basis of accounting used for governmental funds also requires that revenues be objectively measurable and available in order to be recognized. To be available, the revenues must be collectible within the current period or soon enough thereafter to pay liabilities of the current period. Recognition of revenues that do not meet these available criteria must be deferred initially, that is recorded as a liability, but in an account title other than deferred revenue so as to avoid confusion with the new financial statement definitions of deferred outflows of resources and deferred inflows of resources. Then revenues are recognized when available. The expenses of a governmental unit are similar to those of a commercial business enterprise. Expenses essentially reflect the cost of assets or services used by an entity, and they are recognized in the period incurred. Expenditures unique to government accounting typically reflect the use of governmental fund working capital. Thus, expenditures normally reflect the cost of goods or services acquired during a period, whether or not consumed, and the maturing of general long-term debt principal. With limited exceptions, governmental funds recognize expenditures in the period that the fund liability is incurred. So governments use several funds to account for their activities, and numerous transactions between funds or inter-fund transactions occur annually. Examples include sales of services from an enterprise or internal service fund department to other departments, shifts of general fund resources to capital project funds to cover part of the cost of a capital project, and inter-fund loans. Interfund loans are loans that are made by one fund to another and must be repaid. The receivable and payable resulting from an interfund loan appear in the lender and borrower funds. If prompt payment is not expected, the government will require reclassification as a transfer. Interfund transfers occur when one fund provides resources to another for legally authorized purposes, or when one fund helps to establish or enhance another. Transfers are either reciprocal or non-reciprocal, depending on whether or not repayment is expected. Governmental funds record transfers as other financing sources and uses, whereas proprietary funds record transfers in a category following non-operating revenues and expenses. An interfund reimbursement is necessary when an expenditure applicable to one fund is made by a different fund. Reimbursements are not reported in the financial statements. Because resources used within governments typically must be authorized by laws or ordinance, the role and impact on the budget is dramatically more significant in governments than in business accounting. In fact, every governmental unit is required to adopt a budget document, which is often considered more significant than the financial reports. Governmental accounting systems are required to provide appropriate budgetary control, either formally or through the use of budgetary accounts, or informally through the maintenance of separate budgetary records and comparisons. In speaking about a budget, we think of it as a plan of financial operation consisting of an estimate of proposed expenditures for a given period and the proposed means of financing them. Ordinarily, the preparation of a budget is the responsibility of the executive branch of the government, the mayor, city manager, governor, and so on. Approval of the budget, however, is a legislative responsibility. Appropriations are approved or authorized expenditures. They provide legislative control over the expenditure budget prepared by the executive branch. Such control may be in detail, such as when the legislative body makes appropriations for each item included in the budget. The legislative body, however, may approve expenditures by category or in total. So there are a lot of very specific rules around the financing of the government, and this idea of appropriations, allotments, budgets can become very technical and can quite honestly become very judicial in the interpretation of them. So many governments are closely associated with other entities or governmental units which may or may not be economically dependent on the government. When a government has such relationships, the complex question arises about how these entities should be reported in the financial statements of the government. Each state government and each general purpose local government is a primary government, whereas a special purpose government, that's a water district, hospital, or transit authority, is a primary government if it has a separately elected governing body, is legally separate, and is physically independent of other state or local governments. Component units are legally separable organizations for which the primary government is financially accountable. They can also be other organizations for which the nature and significance of their relationships with the primary government are such that their exclusion would result in a reporting entity statements being misleading or incomplete. And so now we want to talk about the comprehensive annual financial report. All state and local governments must report their activities to residents and other interested parties. The GASB Codification states that every governmental entity should prepare and publish as a matter of public record a comprehensive annual financial report that encompasses all funds of the primary government. The comprehensive annual financial report should also encompass all discretely presented component units of the reporting entity. And so this talks to the components of the CAFR. And so we have an introductory section, which has a table of contents, a letter of transmittal, and includes the principal officers and the organizational chart. And then we talk to the financial section of the CAFR, and we have included there a management discussion and analysis, or MD&A, and that's very similar to the what we see on the private side. And there are certain components that must be included there, as detailed in your book. There's the auditor's report. Then we have some government-wide financial statements, which include the statement of net position and the statement of activities. We may also find detailed fund financial statements, and then consistent with any set of financial statements, we have the notes and required supplemental information. And these just provide an example. It's using the City of Golden, Colorado as a statement of net assets. And so you can see we have the various asset types down the left-hand side. And then we have the, this is as of December 31, 2009. We have the different funds, whether it's governmental activities or business type activities. We have the information presented and then consolidated for 2009 and compared to 2008. Continuation of our statements, and these are all presented in the book or in the text. And then we get into the fund financial statements. And with this, we can see the different types of financial statements that are required when reporting on governmental funds. So there's the balance sheet, statement of revenues, expenditures, and changes in fund balance for general funds, statement of net position for proprietary funds, the statement of revenues, expenses, and changes in net position for proprietary fund and similar trust funds. We have statement of cash flows, statement of fiduciary net assets, and statement of fund changes in fiduciary net assets. And so a lot of these terms should seem familiar from the general accounting classes that we've taken, but as we've already seen to this point, there are some very specific and detailed requirements around the models that associate each of these different types of funds. And then finally, we get into a statistical section that includes social and economic data, financial trends, fiscal capability, comparative multi-period accounting and non-accounting data. And the CAFR, as you can imagine, the CAFR of a large metropolitan government amounts to hundreds of pages of information. Although the preceding that we talked about has provided a brief description of the contents, each CAFR is unique, especially in terms of its transmittal letter and MD&A presentation. Although it is not required, many governments also publish other information, such as single audit act reports with their annual CAFR. And so I hope this gives us some idea of the accounting around governmental units. You know, again, this is a class on contemporary accounting issues that as government accountability and as government transparency and as watchdog agencies continue their increased pressure on what governments in general are doing, we're going to see that reflected in things, in reports like the CAFR, where they're direct indicators to the public of what's going on in that agency. So I hope that this has been helpful, and I encourage you to go back and read the book. Please don't let these discussions serve as your only exposure to the information. And I look forward to talking with you again soon. Thank you. Bye-bye.